The renting versus buying question is something we all need to face at some point in our lives. On the one hand, you have the people who say, buy your own property, increase your equity, stop making your landlord rich, and effectively paying his bond. And on the other hand, you might have someone who's a little bit more financially savvy who says, just continue renting and use the money you would have spent on purchasing a house and invest those funds. Living expenses make up most of the average person's budget, so looking into this can be a useful exercise. This decision has many moving parts, so knowing what to look for is very important. We will be considering a property that is similarly sized and located in South Africa, where I'm from. But the average rental in the Western Cape is 9,500 Rand, whereas the average purchase price is between 1.3 and 1.5 million Rand. In this example, I've chosen two properties that are 900 meters apart. The rental costs 9,500 a month, whereas the property we can purchase costs 1.295 million. Both of these properties are 68 square meters. These properties are both 2-bed, 1-bath, and 1 parking. We're going to be making a few assumptions just to make sure that the calculation makes sense. The average inflation rate over the past 10 years in South Africa is 5.2%, which I will be using to adjust all the figures accordingly. Generally, the selling market is more flexible versus the renting market, but in this example, I would just assume that the listing got exactly what they asked for. First-time homeowners generally keep their properties for about 12 years, whereas repeat owners sell after 7 to 9 years. So in this example, I will be considering a term of 10 years. Then minimum bond payments are made monthly, no extra payment is put into the bond. And lastly, that this is a sectional title deal just because I think the levies make for a more interesting comparison. Otherwise, an outright purchase of a house generally dominates. There are links in the description if you want to calculate this for your specific scenario. So in this example, we're considering a house price of 1.295 million. The average interest rate in South Africa over the past 10 years has been 9%, and the home loan term is generally 20 years with a deposit payment requirement of 10%. Some of it will go towards paying the principal capital, which will add to your net worth, and the rest will pay the interest every month. In this example, the deposit payment would thus be 129,500 Rand. So then there are some hidden costs and some not so hidden costs that people just forget to factor in. For example, the bond registration and the transfer fees. The bond registration fee is generally paid to attorneys appointed by the bank to register the bond in the buyer's name. The transfer fees are paid to the conveyancing lawyers to make sure that the bond is then transferred from the seller to the buyer's name. And then finally, you get your transfer duties, which is the tax that is payable for the transfer costs. In South Africa, any property sold under 1.1 million is exempt. So the transfer fees on this property is 75,789 Rand. Another factor to consider is you will have maintenance on that property, which generally equates to about between 1 and 1.5%. So the inflation adjusted amount after the 10 years amounts to about 2,153 Rand and 50 cents. Next up, you need to consider rates and levies. So rates increase by about 5% annually, and in this case, we used a rates calculator for the area to come up with a rate of 685 Rand initially. If you then check this with the increase and inflation after 10 years, you'll be paying about 902 Rand and 50 cents. So the levies are very dependent on the body corporate. In this example, the levies of this property was 1,720 Rand. If I consider that the levies go up monthly by about the rate of inflation and then adjust that over a 10-year period, we're looking at a levy of about 2,288 Rand over the 10-year period. You also have homeowners insurance, which is generally covered by the levy. So in this example, I'm going to exclude it from our calculations. In a lot of cases, banks require you to take out bond insurance to cover them in the case of death, disability, or loss of income, where you are not able to pay them to cover their risk. So they might make this a prerequisite in terms of the loan that they're going to give you. So if you take all of those costs and you add them together, you come to an amount of 16,230 Rand. So next up, you need to consider that every month you're paying off a principal capital amount, which can effectively be seen as a savings account. So if you take what you would be paying into the principal capital amount for the term up to 10 years, it equates to about 30% into your principal capital, and the rest pretty much is interest. If you take that 30% that you're paying into the principal amount and you amortize that over the 10 years, you come out to a price of 3,077 Rand per month that you're basically adding to your net worth. Then there's also the appreciation of the house. Generally, homes grow by between 1 and 2%. In the Western Cape, over the past 10 years, the growth has been around 7.2%. And then, if we consider that inflation is 5.2%, that equates a 2% growth. So, if you consider a property growth of 2% per annum, after 10 years, your property would be worth 1.578 million. If you then subdivide that into monthly figures, you come out with a figure of 2,363 Rand. So, another thing to consider is that when you're selling the property, there might be realtor fees and there also might be maintenance fees, such as maybe painting the house, also updating compliance certification, and those sorts of things. For realtors' fees, it normally varies between 5 and 7.5%. So I'll use the median, which is 6%, and then I'll assume that I can add 1% for maintenance and other costs. So that brings me to a figure of 7%, which then, if I extrapolate that over 10 years, it comes out to 950 Rand and 85 cents. So then if we consider the final cost of having that house over the 10 years, you will have your 16,230 Rand, which includes all of your hidden costs. You can then subtract the 3,077 Rand, which would be allocated towards the principal capital amount that you're going to be paying off on your bond every month. You can also then subtract the 2,363 Rand, which is the appreciation on the house. But then you need to add the selling fees that you're going to pay at the end of the term to get the property sold and out of your hands again, which is 950 and 85 cents. So this then comes out to a cost of 11,740 and 85 cents to own this property. So for the rental example, we're looking at a rental that costs 9,500 Rand, but this only includes the first year figures. The landlord will increase the rent by a specific percentage to ensure that he accounts for inflation and just the general rising costs of living. The average rental increase is between 6 and 8%, so in this example we'll consider a 7% increase. So if you consider the increase after 10 years, it comes out to 18,688 Rand per month. If you then adjust that according to inflation, it comes out at 14,094 Rand per month over the 10-year period. A 2-month deposit is generally required, so in this example, it would amount to a 19,000 Rand extra. So those are generally the costs to rent. We don't have any renter's insurance, and there generally isn't a lot of hidden fees. So now we have to look at the money that we could invest if we consider renting versus buying. We will be assuming an increase of 7.5% after considering the effects of fees on your investment. So if you then take the 75,789 plus the deposit payment and you subtract the deposit for the landlord when renting of 19,000, you end up with a figure of 186,289. If you invest that over 10 years at 7.5%, per month it ends up being 1,726 Rand. This is assuming that you leave the capital to grow and you don't draw any interest from the money for the whole period of investment. We can then subtract this 1,726 Rand from the rental, which then gives us an effective rental of 12,368 Rand per month. So as you can see in this example, these two properties are fairly equally weighted in terms of which one you should go with. The house being a little bit more attractive than renting. But then if you take away the levy payment in the house buying option, it would far outweigh the renting option. So that is why I considered a sectional title versus just an outright purchase. It just makes for a more interesting calculation. So there's a case to make for renting and for buying. For renting, you don't have to worry about the maintenance and you have the flexibility to live anywhere in the world if you choose to do so. But some of the negatives include the fact that you have to deal with the landlord and there's lots of uncertainty whether you would be allowed to live in a certain property for as long as you plan to do so. There's also the security deposit that you have to put up and you can't really make it your own. So then there's the case for buying a house as well, which is the fact that you have the certainty to do whatever you want with your property. You don't have to worry about being put out of your property. So it's just a little bit more stability and certainty. But then on the downside, you also have to consider the fact that there's country risk involved with wherever you're buying. You are exposed to inflation rates and whatever that does, and that's going to affect your payment. And there's the transaction fees. And on top of that, you are also not diversifying your risk in terms of investment. And if you go and invest the money as discussed, you probably won't invest it in only one fund. You would diversify those funds just to make sure that your risk is better spread. Rule of thumb is that if you're going to be moving within 5 years, you should generally look to rent and not to buy. If you know that you're going to be staying for longer than 5 years, consider buying. At this stage, the dust needs to settle for us to see what the interest rates are going to do and where inflation's going to go. So at this point, I feel like there's a lot of uncertainty in the market, and it's a good time to now ask yourself, what do I want to do with my future? Where do I see myself going? And then from there, deciding if you want to buy or if you should just continue renting. Change the assumptions and play around with the calculators in the description. And I hope that you can now make a way more informed decision on what you want to do with your hard earned money as you move forward.